This is the chart of the BSE Sensex. The red, yellow and green zones indicate when the stock market was expensive, fairly valued or cheap on the basis of the market's price-earning ratio or PE. You can see from your experience that most investors have got attracted to investing in the market at times when the markets have been in the expensive zone. This is validated when we see the data for flow of money into the market. While markets have been in the red or expensive zone on 37% of trading days, 72% of all money has come into the market at these times. On the other hand, markets have been cheap for 31% of trading days but have attracted only 3% of the money flow. What this says to us about human behavior is that investors attracted by past returns get greedy and enter equity markets when expensive. Correspondingly, they are struck with fear and decide to sell out when past returns look bad. Prudent investing demands the exact opposite in terms of behavior, that is, moving out of equity as markets get expensive and moving into equity when markets get cheap. The IDFC Dynamic Equity Fund exhibits this opposite but prudent investing behavior. It buys less equity as markets get expensive and buys more as markets get cheap, thus formalizing good investment strategy. The IDFC Dynamic Equity Fund has the flexibility to move from 100% to an effective 30% equity exposure to dynamically reduce equity exposure as markets get expensive and vice versa. Due to its nature and strategy, the Dynamic Equity Fund lies somewhere between debt and equity as far as risk and return goes. This table shows at a glance the fund's allocation to equity based on how expensive the market is as defined by the market PE and fine-tunes that allocation based on market momentum indicators. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.